Today, Governing Council maintained the policy interest rate at 2.75%. Uncertainty remains high. The Canadian economy is softer, but not sharply weaker. And we've seen some firmness in recent inflation data. Against this backdrop, we decided to hold the policy rate unchanged as we continue to gain more information on U.S. trade policy and its impacts. Aujourd'hui, le Conseil de direction a maintenu le taux directeur à 2,75. L'incertitude reste élevée. L'économie canadienne s'est affaiblie, mais pas de façon marquée. Et les récentes données sur l'inflation sont légèrement plus fortes que prévu. Dans ce contexte, on a décidé de laisser le taux directeur inchangé le temps d'amasser plus d'informations sur la politique commerciale américaine et ses effets. Le conflit commercial déclenché par les États-Unis reste le plus grand obstacle pour l'économie canadienne. The trade conflict initiated by the United States remains the biggest headwind facing the Canadian economy. Since our April decision, the U.S. administration has continued to increase and roll back various tariffs. China and the United States have stepped back from extremely high tariffs, and bilateral trade negotiations have begun with a number of countries. The extreme financial turmoil we saw in April has moderated, and stock markets have recovered their losses. However, the outcomes of the trade negotiations are highly uncertain. Tariffs are well above their levels at the beginning of 2025, and new trade actions are still being threatened. The recent further increases in U.S. tariffs on steel and aluminum announced today underline the unpredictability of U.S. trade policy. In addition to the uncertainty about U.S. tariffs, there's also uncertainty about their impacts. At its April decision, Governing Council said it would pay close attention to four things: the extent to which higher tariffs reduce demand for Canadian exports, how much this spills over into business investment, employment, and consumer spending, how much and how quickly cost increases are passed on to consumer prices, and how inflation expectations evolve. Since then, there is partial information on some of these risks and uncertainties. Let me provide an update. So far, the U.S. economy has proven resilient. Imports were strong as businesses tried to get ahead of tariffs, and that pulled down first quarter U.S. GDP. But domestic demand remained relatively strong. Early indicators for the second quarter suggest a rebound in growth as imports fall back and domestic demand continues to expand. The flip side of the strength in U.S. imports was a surge in Canadian exports. This boosted first quarter GDP growth in Canada, which came in at 2.2%, slightly stronger than the bank had forecast. The composition of growth was largely as expected. Exports and inventories were strong, but final domestic demand was roughly flat. Strong spending on machinery and equipment held up growth in business investment by more than expected. Consumer spending slowed from a very strong fourth quarter pace, but continued to grow despite a sharp drop in consumer confidence. Housing activity contracted as resales fell significantly and government spending also declined. The labor market has weakened, with job losses concentrated in trade-intensive sectors. The unemployment rate rose to 6.9% in April. So far, employment has held up across sectors that are less exposed to trade. But businesses are generally telling us they plan to scale back hiring. The pull forward in exports and inventory accumulation in the first quarter borrows economic strength from the future. So the second quarter is expected to be much weaker. Spending by Canadian families and businesses has shown some resilience in the face of U.S. tariffs and heightened uncertainty. But they are likely to remain cautious, suggesting domestic spending will remain subdued. It's still too early to see the direct effects of retaliatory tariffs in consumer price data. What we can see clearly is the impact of the elimination of the consumer carbon tax. This knocked 0.6 percentage points off inflation in April, largely due to lower gasoline prices, and pulled headline inflation down to 1.7%. This tax effect will remain in the year-over-year change in the CPI for the next 11 months before falling out next April. Inflation, excluding taxes, was 2.3% in April, slightly stronger than the bank had expected and up from 2.1% in March. The bank's preferred measures of core inflation, as well as other measures of underlying inflation, moved up in April. There is some unusual volatility in inflation, but these measures suggest underlying inflation could be firmer than we thought. Higher core inflation can be partly attributed to higher goods prices, including food, and may reflect the effects of trade disruption. Many businesses are telling us they are already facing higher costs related to finding alternative suppliers and developing new markets. The bank will be watching measures of underlying inflation closely to gauge how inflationary pressures are evolving. The bank is also watching inflation expectations closely. In April, we reported consumers and businesses expect prices to rise as a result of tariffs, while longer-term inflation expectations remained well anchored. Recent surveys continue to show consumers are bracing for higher prices, and many businesses say they intend to pass on tariff costs. Le Conseil de direction va continuer d'analyser l'évolution et la force des pressions.
To assess the timing and strength of both the downward pressure on inflation from a weaker economy and the upward pressure on inflation from higher costs. At this decision, there was a clear consensus to hold policy unchanged as we gain more information. We also discussed the path ahead for the policy interest rate. Here, there was more diversity of views. On balance, members thought there could be a need for a reduction in the policy rate if the economy weakens in the face of continued U.S. tariffs and uncertainty, and cost pressures on inflation are contained. Faced with unusual uncertainty, Governor Council is proceeding carefully, with particular attention to the risks. This means that we are being less forward-looking than usual. Our priority is to ensure that Canadians continue to have confidence in price stability through this period of global upheaval. We will continue to support economic growth while ensuring that inflation remains well controlled.
Governing Council will continue to assess the timing and strength of both the downward pressure on inflation from a weaker economy and the upward pressure from higher costs. At this decision, there was a clear consensus to hold the policy rate unchanged as we gain more information. We also discussed the path ahead for the policy interest rate. Here, there was more diversity of views. On balance, members thought there could be a need for a reduction in the policy rate if the economy weakens in the face of continued U.S. tariffs and uncertainty, and cost pressures on inflation are contained. Faced with unusual uncertainty, Governing Council is proceeding carefully with particular attention to the risks. This means we are being less forward-looking than usual. We are focused on ensuring that Canadians continue to have confidence in price stability through this period of global upheaval. We will continue to support economic growth while ensuring inflation remains well controlled. And with that, the Senior Deputy Governor and I will be very pleased to take your questions.
Okay, thank you, Governor. We will go to questions now, and we'll start with the reporters here in Ottawa at the bank, and after that, we'll go to those who have joined us remotely. As usual, I'm going to ask you to please limit yourself to one question so every media outlet does have a chance to ask a question, and if I forget to do so, please state your name and affiliation. Avant de poser votre question, veuillez vous identifier.
Before you ask your question, please identify yourself, and of course, you are free to ask your questions in either of the official languages.
Go to our first question here in Ottawa. I'm going to start with Paul Vieira from the Wall Street Journal, please.
Governor, does inflation need to slow in both May and June before senior bank officials would consider a rate cut on July 30th?
Well, as I think you're suggesting, we will get two more CPI reports before our next decision in July. And yes, we will be looking at those carefully. I guess what I would stress is we did see, well, CPI X tax moved up in April. And I think more significantly, if you look at our preferred measures of core, and in fact, if you look at a range of alternative measures of core, if you look at the distribution of price changes, the percentage above 3%, what you can see is they all moved up in April. That has got our attention. I will say, though, that there is some underlying volatility in inflation. Some of the components, particularly travel, tours, for example, have been very volatile. So you don't want to kind of over-rotate on 1 month's CPI data. But the fact that quite a number of measures of core or alternative measures of core all moved up does make you think that underlying inflation could be a little bit firmer than we thought. So that is something we will be watching. And what we've indicated is that, look, we're looking at both those downward pressure on inflation coming from the weaker economy and the upward pressure on inflation coming from costs. And yeah, we'll have to factor all that in July.
Okay, Kevin Carmichael from The Logic, please.
Something of a follow-up on Paul's question, Governor. You said in your statement that you could be persuaded to lower rates going forward if inflation remains contained. What does contained mean? Is that contained at current levels, or do you need to see inflation come off a bit?
Well, I know you'd like us to give you like one number. Here it is. That's a line in the sand. It just doesn't work like that. I mean, there is a lot of uncertainty. We're being less forward-looking. We still need to be forward-looking. So yeah, we're going to look. We're going to look and see. I think the big message here is, look, the Canadian economy is showing some resilience to tariffs. Yes, consumption was softer in the first quarter. You can see the impact of tariffs on consumption. But, despite a really big drop in consumer confidence, consumer spending did continue to grow in the first quarter. Business investment was actually a bit stronger than we expected in the first quarter. So, you can definitely see the impact of tariffs, but, there is some resilience. Having said that, look, the longer these tariffs go on, the longer this uncertainty goes on, the more it's going to weigh on the Canadian economy, the more that is going to put downward pressure on inflation. And we will be watching that very carefully. But we are also conscious that there are cost effects of tariffs. We're seeing that already. The trade disruption, what we're hearing from firms is that the trade disruption is already adding costs. They're looking for new suppliers. They're developing new markets. That's adding costs. And the retaliatory tariffs that put in place, that is not in the yet in the CPI data that we have. You will see that start to come in the months ahead. So we will be looking at both those things. And as I discussed in the opening statement, in our deliberations, we did talk about the future path, and the Governing Council thought that there could be a need for a further reduction in the interest rate if the tariffs continue, if that creates more weakness in the Canadian economy, and if the cost pressures coming through in inflation are contained. I wouldn't interpret that as forward guidance. That was part of our deliberations, nothing more, nothing less. The only forward guidance we can give you really is as I've already indicated, given the unusual level of uncertainty, we are proceeding carefully. And what that means is that we're being less forward-looking than usual.
Okay, let's go to Eric Hertzberg from Bloomberg, please.
Hey, good morning. Question on the loonie. Given the potential for more hedging from Canadian investors, the very low starting point of hedge ratios right now, would the bank be willing to look through any material rally in CAD within the context of its policy framework, or would you folks view that and weigh it as disinflationary?
I mean, as you know, Eric, we don't have a target for the Canadian dollar. We do, the Canadian dollar is one of the sort of balancing factors in inflation dynamics. I mean, the governor just went through in a lot of detail what we're looking at. There's no single metric we're looking at. We do think that the Canadian dollar has strengthened recently. We do think that's had some effect on inflation, but I mean, we have to weigh it against all the other dynamics. It's not a sort of, again, there's not a kind of magic formula or a single data point that we look at.